Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj, Ethiraj. The big story this week, the index of industrial production has contracted by 4.2% for October compared to 2.5% in September. The only good news, if any, is that consumer price index or inflation has cooled to 4.38% for November, a record low once again. Contrary to expectations, the IIP contracted 4.2% in October. Manufacturing, which accounts for over 75% of the index, contracted by an amazing 7.6%, while mining and electricity sectors grew at 5.2 and 13.3% respectively. On a user-based classification, the sharp fall in the consumer durables category, which contracted 35%, suggests that consumer sentiment is still very weak. Capital goods, considered a proxy for investment demand, declined 2.3% after growing at 11.6% in the previous month, which also suggests that a revival in investment demand, or the investment cycle more appropriately, is a little while away. Well, joining me now to discuss the impact of the somewhat shocking numbers are Dr. Brinda Jagirdar, former Chief Economist at the State Bank of India. Brinda, thank you very much for being with us. What does one make of this? Is it a secular downtrend that we are now seeing, if one were to put it in retrospect?
No, I don't think we should look at it that way. First of all, the numbers are a surprise because one didn't expect the magnitude of this fall. I mean, fall of this magnitude. Because we are seeing a lot of positive features in the economy. If you look at the, say, freight movement, whether the railways or the port, you see an improvement. You see an improvement in tourist arrivals. You see an improvement in the core sector numbers. So there are a lot, and of course, a lot of policies are still.
When you say core sector numbers, that would be
electricity.
Okay.
And several sectors have been performing pretty decently. So this number of a decline of 4.2% does come as a bit of a shocker, and manufacturing at
which is a large component, yes, yeah.
Yes, manufacturing is about 75% of the total IIP. So naturally, it has brought the index, has dragged the whole index down because manufacturing has declined.
But what is more surprising, the fact that it's gone so sharply down, or the fact that this has happened unexpectedly?
No, the fact that it has both, of course, both are surprising. But the fact that it has gone down by so many, because in the last 6 months we've seen the IIP improving, remaining flat at times, but at least it's been positive. It's moved from negative territory to positive. So that is why it does.
So were we taking things for granted then?
No, it just shows that there is still work to be done, and there is still a lag in the economy. So these things will take some time to come on and show its impact.
When you say lag in the economy, meaning you're seeing some signs of an uptick, but that will take time to actually manifest themselves in the numbers.
There are some signs of uptick, like I mentioned a few already. Okay. And we do hear about several stalled projects getting off the ground, and we do hear about new projects being at least coming on the table. So in that sense, there are green shoots visible here.
But fundamentally, consumer demand as well as investment demand seem to be sluggish, if not slow. So, I mean, isn't that a more deeper problem, particularly consumer demand?
Consumer demand being negative 35% is really quite a surprise, quite a shocker. And this time, even during the festival time, the sales didn't pick up as much. So that, yes, that does show.
So that's my question. Is there something fundamentally, or are we missing something that's going wrong?
What has happened is that capital goods, which is a proxy for investment, has remained in negative territory for over 2 years. Now the private sector is excessively leveraged, and the private sector has excess capacity. In fact, in certain industries, it's as high as a 10-year peak. So on the private sector,
for example.
I mean, steel is one area. Now, and then that is so far as investment is concerned, private sector investment. And where in consumers are concerned, it was inflation, remember, which was which is really very high the last 3 years. So again, that has made the consumers very wary. So consumer sentiment remains a little low. Now, what can pull us out of this situation? One, of course, is government investment coming on, but government, let us remember, is constrained by its own fiscal deficit. So here, what can be done is that the private, the capital expenditure, as I think the government is rightly doing so, give a boost to the capital expenditure and get in FDI. So once we have FDI, because FDI is waiting and ready to come in, and the government has also expanded policy, liberalized policy. So for example, in railway infrastructure, for example, in defense, and even in construction they've made some liberalization.
Right,
so
but all of this to materialize will take some time, and that's the lag that we've been talking about. Let's look at the other number, which of course is the good news. That's inflation, which is now down to 4.38%, right, which is a record low, if considering that we started in 2012 for this series. What does that mean?
Well,
I mean, it's good news at one way, but is it also bad news in another way? Because considering that obviously if spending capability or purchasing capability is going down.
No, let's look at this. Is a lot of it is from the base effect. So let's not forget that,
sure,
because September, October, November last year the inflation was very high. So that impact is being seen now. So what all the eyes are now on the next number, which will come out sometime in mid-Jan. So that will tell us whether inflation is really seeing a secular trending downwards, or whether this was just due to the base effect. So I think that is very critical, and that is very important.
But the fact is that things are soft. I mean, prices are surely either stabilizing or not going up. Is that
Absolutely.
that would be a safe conclusion to draw.
Yes.
Now let me add the two or three other factors in the mix. One is of course oil prices. The other is commodity prices, as they've been going down. Oil has hit a 5-year low now. How does this add to this mix, and does the combination of this mean good times for the citizen or the consumer?
The combination means,
or at least not bad times.
Yes, the combination means that we have work to do, and this is a time for us to really get serious about the work we need to do. Now, oil prices being down, yes, it is certainly good news for countries like India, which are huge importers of oil. But remember, we also export to countries which are oil producers. So if their demand is weak, then our export demand is also going to be hit. So it's not an unending good news, but certainly it's a lot of good news. So oil prices coming down is good, and its impact, and commodity prices coming down is also good. But at the same time, I think now this is a time to really seriously look at our manufacturing sector, because in say China, for example, manufacturing is close to about 35%, and in other countries, not just manufacturing but high-tech manufacturing, in Germany and Japan is close to 60%. So what we need to do is increase our value addition in manufacturing, increase our value addition in exports.
But that will also take time.
Yes, all this will take.
So let me ask you once again. So your takeaway, the composite of all of this, the lower IIP numbers, the lower inflation, and of course combined with the fact that things on the external front are looking somewhat benign, if not good.
Well, like I said, this is work in progress. These are all good, fortuitous events that we have been faced with, and I think it's now up to us to make the best of all these.
So see this as a good opportunity which we should capitalize on quickly, but of course wait for the lag effect to take place.
What you said is right. Quickly is a key word. We need to get to work quickly.
Right.
And we need to really ensure that this improvement in sentiment, which we are seeing in some investor segments, this gets translated into actual growth.
Right, Brinda, thank you very much for speaking with us. Well, we go into a break on Policy Watch. On the other side, we talk about the new Indo-Russian deals that have been signed across nuclear, oil and defense. Stay with us. Welcome back to Policy Watch. Russia will remain India's foremost defense partner, Prime Minister Narendra Modi told Russian President Vladimir Putin, even though New Delhi's options had improved since the Cold War, he said. The two sides have signed billions of dollars of deals in nuclear power, oil and defense. 20 agreements have been signed in all. The biggest deal will see state-owned Rosatom building 12 nuclear reactors in India, while oil major Rosneft signed a 10-year crude supply deal with SR Oil. India has also agreed to assemble 400 Russian multi-role helicopters a year. Times have changed. Our friendship has not, the Prime Minister of India tweeted. Well, joining me now is former diplomat, Russian-speaking, and who's also served in Moscow, G. Parthasarathy. Mr. Parthasarathy, thank you very much for joining us. So, a bevy of deals signed between India and Russia. At the same time, the US State Department saying that that it's not time for business as usual with Russia. That's the US point of view. What is this all adding up to? India, of course, saying quite, in a very, very strong way that the friendship with Russia is very strong, and which of course is also translating into a lot of economic deals and potential collaborations across defense, oil and nuclear.
You see, it is only to be expected that the Americans will voice certain points of views and concerns about any relations of ours with Russia. This is a historical fact and we have to live with it. It is not the United States which will determine what our relations with Russia will be, just as we will not determine what United States relations with China are going to be. They take those decisions. And we will go ahead with our cooperation with Russia. Russia has been a time-tested friend. It has stood by us in hours of crisis. And let's be very clear on economic matters and in fact going into high technology areas like communications. The Russians have been crucial partners. If today we are able to send a vehicle to Mars, if today we launch the best satellites, amongst the best satellites in the world, the fact is that it is due to Indo-Russian cooperation in space and the technology for cryogenic engines. And I don't think we should forget that it was the United States which tried to block Russia's supply of cryogenic engines to us for our space program.
Let's keep the US part aside. I mean, I just mentioned that because the State Department issued a statement just now. If you were to look at just the Indo-Russia part, there is a 10-year crude supply deal with SR Oil. India will assemble 400 Russian multi-role helicopters, and of course there are those nuclear reactors. Was it time, or could it have been time for India to explore new partnerships in the Western world or elsewhere for all these potential collaborations?
Look, the fact of the matter is that the Russia has the largest reserves of energy in the form of natural gas. If we can get natural gas and oil from them, fine. There are problems of transportation. But despite that, what has happened is that we have got a huge investment in the Sakhalin gas fields, which have been a successful investment. The exploration has been successful. Then apart from that, we are looking for other sources. The real problem, as I said, is transportation. We can do switch deals by which they supply it to a third country and we get a supply from a nearer thing. We've done it in the past with Iraq. So yes, potential for energy is immense. They are talking about a pipeline which we could examine jointly through what is called as the North-South corridor, or which is the Caucasian corridor, which ultimately extends into Iran. So these are certainly projects we need to look at in energy. Yes, there are deals our private companies are striking with Russia. We should welcome it, because the important point for us is to have the access to energy, whether it is oil or gas. And in both cases, the Russians can supply us either directly or indirectly.
I see the point on energy, and I'll have a question on that in a moment. But there's also, I mean, there are 20 deals signed in all, and many of them are also in defense. Could it have been the case that we would have, let's say, explored building helicopters with some other kind of technology or another company or another nation?
Look, there are different types of helicopters. There are military attack helicopters. What we are looking at is excellent transport helicopters, both for military and civilian transportation. Now, Russia has come forward with a very forward-looking proposal to build these in India, and President Putin has assured that even the spares industry will be developed in India with freedom to export. So this fits in perfectly with Mr. Modi's plans for Make in India. We can't be constantly importing these countries from such equipment from third countries, and this will be massive insofar as the application is concerned. As I said, it would extend both into military and non-military areas. And the Mi-35 helicopters from Russia, which we received earlier, proved very hardy and reliable.
So, should there be some concern, Mr. Parthasarathy, that given Russia's relatively weak economic position, precipitated of course by a fall in oil prices, that some of these projects might find difficulty in seeing fruition?
Look, one thing we should be very clear of, one cannot doubt the magnitude of Russian innovativeness in matters pertaining to industry, particularly defense industry and space. That's unquestionable. Now, they do have financial problems, and what we need to look at, which we are doing for the futuristic 5th generation fighter aircraft, is to develop it jointly. One of the best missile systems in the world, cruise missiles, is the BrahMos, jointly developed by India and Russia and manufactured now in India. So, what we are looking at is a collaborative venture where the capabilities for manufacture are built in India.
Okay, so just to come back to the crude point, the crude energy and the crude and energy question, Mr. Parthasarathy, if would you say then that most of the bet in the Russia-India relationship or equation at this point is really dependent on energy and our needs of it?
Well, our needs of energy are only going to grow. And let us remember that the largest potential for natural gas is in Russia. They have a massive deal with China. And what we need to explore, as we have done in the case of Sakhalin, where we invest, the oil is supplied to a third country and we get alternate supplies. Similarly, in the case of gas, we need to explore possibilities, especially of what they talk as the north-south corridor through the Caspian, as to whether we can get gas economically. Gas prices are falling, but while we can certainly look at Australia for our east coast, if the Russians are willing to do switch deals or direct deals with us for gas, it is certainly important for the development of our west coast.
Right. So, to sum up, Mr. Parthasarathy, are you seeing it as a complete win-win or any areas of concern?
Look, I started my diplomatic career in Moscow, and that was over, well, nearing now 45, 50 years ago. And the Russians have never let us down. Now, they do have economic problems, they are facing sanctions, but remember, this is a country which has fought wars against Napoleon and Hitler and won. So, we should go by their resilience, and since they have stood by us, this is a long-term thing. And the other important point is, there are no strings attached or sanctions threatened in the case of our relations with Russia.
Right, right. They've always stood by us. A good point to end on. Thank you very much, Mr. Parthasarathy, for joining us. We need to take a break here, but coming up on the other side, we talk about the State Bank of India's newly launched economic indices, which will take on potentially some of the other manufacturing indices popularly used right now. Welcome back. India's largest lender, the State Bank of India, has developed two indices to track the changes in the economy. The two indices are the SBI Monthly Composite Index and the SBI Yearly Composite Index that will allow for long-term growth forecasts. The SBI will use its internal loan portfolio and other data sets in public domain for these indices. According to the first composite index released this week, which are also termed as conservative and leading indicators, manufacturing activity jumped over 16% in December. That's the clearest signal of revival in the economy. It's also expected to be more accurate than similar indices like the HSBC Purchase Managers Index that are survey-based. SBI Chairman Arundhati Bhattacharya said the index reflected credit demand in the economy as the bank commands the biggest share and reach in the banking sector. Joining me now to discuss this is Soumya Kanti, Ghosh, Chief Economist at the State Bank of India. Soumya, thank you very much for speaking with us. Why this index at this point?
See, we had actually indicated that we are going to develop an index when we were having a banking and economics conclave in June. And our chairman had indicated a desire that if we can develop an index, because State Bank's lending portfolio is one of the largest lenders, maximum market share, and it mimics the credit growth and the obviously the economic growth. So subsequently we thought, why not develop an index which takes into account not only the credit to various sectors by SBI, be it large industry, be it corporate, be it services sector, be it housing or anything else, and combine in with the leading indicators. Right. So the leading indicators could be tourist arrival, could be coal production, could be cement dispatches, could be telephone connections, or it could be anything.
So are you saying that these are some of the factors that are distinct from the existing indices?
Exactly. So we decided that we will combine both of these and then develop an index which could also go back historically in time series. So that's why we have developed an index from October 2006 onwards, to be more precise. So that means that it indicates, it covers the period when the economy was in a business cycle downswing. It also covers the period when the economy was just recovering after the crisis, and it also recovers when the economy is now actually in a downswing. Right. So that's why it gives a very good description of what could be the factors or turning points in the manufacturing cycles by looking at the SBI Composite Index.
Right. So now you're saying that it's up 16% in December. So is that good news or not so good news? news?
See, it's a good news in the sense that there are two indices over here.
And this is month on month.
Yeah, we need to remember that the month on month index, which was around 47.5 I think in November, has moved up to over 55 in December. But we need to remember that there is a seasonal element also involved over here, which has not been removed from the monthly index so that it mirrors the IIP month on month manufacturing growth in a better manner. However, the year on year growth index has been deseasonalized, but that index also shows a growth, but that is a modest uptick.
Right.
So the point which I am trying to make is that yes, if you look at the data both in terms of the month on month, there has been an increase in sentiment, clear increase in improvement in sentiment for November, and even if you look at the year on year growth, the index has been slowly inching upwards.
What's the biggest difference between this index versus other indexes that this captures, which in a sense should give us comfort that, oh, okay, you know, the economy is either in good shape, because we know that this index is getting hold of this element?
See, basically, I mean, if I just go by the statistical validation, these and there are two statistical validation which always one has to do when developing any methodology. The first is the in-sample validation. Within the sample, then is the out-sample validation. If you look at the in-sample and out-sample validation of the SBI Composite Index over a period of October or the last 8 years, the validation comes to around 72%. For any financial variable, a validation of 70% is supposed to be very good. Okay. And if we just compare the corresponding indices in the market, for example, even if PMI, the validation results are less than 50% or close to 50%. So from that point of view, and given the fact that this is based on real-time data rather than survey-based, it will send out signals that the economic recovery could be on the
So let me ask you the bottom line question, Soumya. By looking at this index, is this changing your perception or your analysis of the economy as it stands today, or is it roughly the same as what we've been concluding from other factors, including the GDP numbers?
See, as far as our expectations are concerned, it is largely mirrors what we believe, that there is an uptick in the growth more pronounced in the fourth quarter of this fiscal.
And where is that
January
coming
to
from?
March. So primarily, there is, if you look into the data, there has been some amount of uptick in the infrastructure sector's growth rate, which is mimicking in the credit portfolio of the bank. Regarding the non-infrastructure growth rate is concerned, I think that is yet to happen, and once that happens, this index could actually show a larger uptick than what it is currently showing.
Right, but though it is somewhat connected with your credit portfolio, but the index does not necessarily lean only on the credit portfolio. Would that be correct?
No, it doesn't lead on the credit portfolio. Credit portfolio is only a part, I repeat, only a part, but a significant part in explaining what could be the index look like in any given month.
Right. And what are you seeing within this index, or in an overall sort of economic sense, that suggests to you that there is more revival or an uptick around the corner?
See, I'll give you some very interesting insights from the index. One of the factors which we saw was a very significant impact on the index. For example, was the mining growth rate. And you will not believe it that given these, there has been some long gestation periods in the last couple of years regarding the mining and coal sector. The mining sector had a very positive coefficient with the index, but that was with a significant lag. So that means that any policy uncertainty like this one always impacts the growth rate with a pronounced lag. This is point number one.
And vice versa.
And vice versa. The other point is that if you look at this, now that the oil prices at historic lows, over that index when it was, which has been built, and I think larger part of the index was built when the oil prices were actually running at higher levels. Only in the last couple of months, oil prices have dipped to such low levels. So if we look at the oil prices also, we see that the government has also not passed on fully the oil price increases to the domestic industry or the consumers, and that also has a positive impact on the index. So that means that when the oil prices will go down, that may even have a larger impact on the index. And finally, the other point is that if the SBI, the credit of the SBI also to the larger corporates, that is also another significant, one of the significant factors in explaining the
So last question, Soumya, what's the reverse? I mean, so I asked you about the uptick. What in this index or the constituents of this index as you measured it give cause for concern?
See, one of them obviously is the delay in policy uncertainties. The other thing could be that some of these variables, for example, like these indicators, the leading indicators like the tourist arrivals, or for example the coal dispatches that are not moving up to the mark. The other thing which bothers me regarding the index is that if you actually look into these data, if the credit growth does not see and continue traction on a month-on-month basis, that may pull down the indices a little bit,
and that's the economy,
and that's actually the economy. But as of now, we see that the numbers are slowly picking up, and as I explained to you, credit growth to the infrastructure sector, an uptick in the credit growth to the infrastructure sector, given that the government has been trying to declock all these projects, is having a positive impact on this number.
Soumya, Kanti, Ghosh, thank you very much for speaking with us. That's all we have time for on this edition of Policy Watch. We'll be back next week, same time. Thanks for watching.